How's it going? My name is Robert,
My name is Chad.
and we are the show Intellectually, the show where we teach you how to hold us professionals in the real estate industry more accountable. And we have a topic that we kind of want to hit on that's become more recently flamboyant, even though it's been something that's been festering for quite some time, right?
Yep, and that is the private credit market.
Yeah.
We're seeing quite a few dips in the shares of the big, large investment private equity creditors out there, like
Yeah.
BlackRock, Blackstone, Blue Owl. We're seeing massive drops in their shares, up to
Lots
over
of fun.
6%.
Yeah.
We've seen that within the past month.
Yeah, so we got a little excited about this topic because there's so many YouTube channels, so many, news reporters that are announcing this as a big deal, a big sign of a huge recession coming in, particularly around, would you argue, the commercial industry and maybe the stock market?
Oh, absolutely.
Yeah.
Absolutely.
So we're a real estate company, so there's no point in getting in depth about stocks and different investment strategies there. But I think it is strategic to speak to how this might affect you and the real estate, residential, commercial, and investment industry in general. So you were doing some digging.
Yeah, so we'll give you a little bit of history on the private credit market.
Yeah, what are they?
That's up to nearly $2 trillion right
Yeah.
now. Started back right after the 2008 recession that we went through.
Okay.
Obviously, we've gone through that time. We've seen what happened, and right after that, essentially, more regulations came down to hold these banks a little bit more accountable to, giving out more, I would say, qualified loans than
Yeah.
they gave out.
So 2008 recession, Great Recession. One of the ways they kind of set barriers up to keep that from happening again was put more restrictions on banks, a lot
Right.
more accountable, right? So these bank firms, these different lenders and creditors have a lot more restrictions when it comes to giving out loans to the average consumer, major
Absolutely.
business. So in turn, what did we accidentally create?
Well, we accidentally created the private credit
Yeah.
market, right? Where you had these big institutional investors come in and say, hey, we've got a bunch of capital. Why can't we give out loans?
Well, it's even on top of that. It's not like they had a bunch of capital. They had a lot of trust, right? Because, all any currency is trust, right? The human dollar literally says it's a promissory note, right? And that being said, these companies were big enough to gain the trust of investors to say, hey, I'm going to give you money. And they weren't necessarily super clear with what they were going to do with the money when they lend it out to these private firms. And these private firms got approved based off, qualifications that they found fit and bought up some real estate. What kind of real estate in particular?
Commercial.
Commercial, right? So commercial's back on top again. For the past 5 years, we've been worrying about the commercial real estate industry. This is no surprise, right? We used to be worried about the office portion of commercial real estate industry. Nobody wanted to go in the office. They wanted to work at home. And now we were worried about maybe like retail commercial, in which retail was struggling, and particularly malls. So commercial investors were having trouble there, and now we're looking at this, and literally the location the commercial investors got their money to purchase or to gain the property in commercial are now struggling, right? So talk to me about, you brought up a couple names. What are some big names that we're having trouble with when it comes to?
Yeah, we'll start with BlackRock.
Okay.
After Morgan Stanley, in their last regulatory filling,
Yep.
made it known that they are going to limit its redemptions.
Yeah.
After investors attempted to withdraw nearly 11% of redemptions, I believe they only
Do you have the number of what 11% was, the amount?
11%. So
It's okay if you don't. I'm interested.
So it's about 1.4, 1.5 billion.
Yeah.
Something
crazy.
along those lines. Yeah,
Yeah.
it's billions. We're talking
Oh, yeah.
billions
Oh,
of
yeah.
dollars here. But they only paid out about 5% of those.
Yeah.
5% of that 11%.
Yeah, and I look at it. It's funny because it sounds so scary, right? People are like, they're not paying it because they can't. They're not paying it because they actually don't have to. I wouldn't be surprised if there were, in those terms, plenty of scenarios that would say, hey, you can only pull out this certain amount of funds at this, percentage at this time.
Yeah, I think too, and the question that needs to be asked here is, I guess, why is there such a large request for withdrawals right
Yeah.
now through these investors, right?
Which you
It's
would-
not really it obviously it is important
Yeah.
to understand, what the withdrawal limits are and what as an investor you can take out, but why is there such an increase
Yeah.
in these withdrawal requests or these redemptions
Yeah.
is what they're called?
So 2 topics there. I guess I'll finish mine up, right? Do they have to give all the money back?
No.
We don't necessarily know, but in their contract term, probably not. And I bring the idea up, and I definitely want to address yours, like what's motivating them to get their
Sure.
money. But I do want to make the point, everybody's seen The Big Short. Everybody loves the movie The Big Short. And there's that part where, who played Batman?
Christian Bale?
Christian Bale's character.
And he's the movie guy. It's the funny thing.
right. But Christian Bale's character, a lot of firms that he handles the financials through, they wanted to pull their money out, and he literally, according to their contractual agreement, said you can't take the money under certain circumstances. I have full control over this. So it wouldn't be surprised to see that BlackRock, Blue Owl, Blackstone, and all these other major companies also have some kind of safeguard in there too.
Absolutely.
So it's not surprising. We shouldn't be scared saying like, "Holy cow, they don't get
Well,
the
it's
money,
funny
they
too
can't give it."
because these investors
Yeah.
signed up and they knew exactly what the withdrawal limit was. You would hope.
Yeah.
Yeah. That was put in the
maybe.
paperwork.
I've seen some
but who knows?
investors. Yeah, I've seen some big business owners that are just like, you worry about that, you worry about that, and unless you're the owner, you're really not worried about it. So I wouldn't be surprised if a couple of them are genuinely surprised. But I want to come back to that. I really like your idea of why might they be looking at pulling, right? You brought up the most obvious things that are going on in the world. What,
Well, we have conflict going on right now.
there's some turmoil going on, over here in our
Or-
country. It's not
yeah.
as epic, but
Oil prices are rising.
yeah. So we got
inflation's
oil
going up.
prices. We got a lot of turmoil over in Israel, Iran. and
Tariffs are
areas,
still
yeah.
playing a part in this.
Yep, tariffs are a lot more. Tariffs are now being executed. There were a lot of holds, or I guess exceptions when it came to tariffs, and now a lot
And
more
our military
tariffs.
spending too.
Military
Who
spending's
knows
going
what's
up,
gonna happen?
obviously, because of Iran and Israel crisis. So all those things, yeah. When turmoil takes place, money becomes less confident. And like I said in the beginning, the U.S. dollar or any form of currency is simply trust in the entity that holds it, right? Holds it viable. And when you see that entity doing a bunch of crazy things, you're going to start to make drastic decisions with your money. So that's one huge reason, could be. You also, then we dove into something else. What was the one company that we found most interesting about this?
Blue Owl.
Blue Owl, right?
Yeah, absolutely.
Yeah, so Blue Owl was created when?
2021.
2021.
And it was merged.
Yeah,
they were
merged.
merged together to create Blue Owl in 2021.
Yeah, the
Yes.
Endeavor, the project was created. And your average private credit loan is going to
Lasts.
be, it's going to be 3 to 7 years. And the
Yeah.
average of that is 5 years, right?
So, we talked to 2021. We're about 5 years after those loans.
Yeah. So
Right?
that being
They've
said,
matured.
they've matured. So we're ready to use our money for something else, right? Maybe there's a better opportunity. Interest rates are much higher. So maybe I want to disperse my money into different assets. Maybe diversify my portfolio in this area. So I want to go in, and naturally, you're going to go in when the loan matures, right? And so a lot of loans are probably maturing, and who is the company that's suffering the most, or at least one of the companies suffering the most?
From that maturing
Yeah.
is BlackRock.
Well,
Blue Owl.
Blue Owl, based off their size. Yeah. BlackRock's also suffering.
I didn't even
No,
hear
you're
your
good.
question.
No,
Sir.
you're
I was
good,
paying
you're good.
attention.
Well, you were the one that actually said this when we were talking about it. But yeah, Blue Owl's definitely based off their size and their success. They're the ones suffering the most, right? They're the one getting hit with the polls.
Oh, absolutely.
And it's not surprising. They've been around for 5 years, and that's the average mature.
And it's not like they have a bunch of liquid cash sitting around. Too,
Well, that's
as
the trouble with this, and that's
Yeah.
why they're not giving all the money back. Alexa, stop. She's ready. She's listening. She's like, I got to shut these guys up. They're
Maybe
onto
she
something.
should do our next podcast.
Oh man, that'd be so nice. I could take a nap, eat a snack. But so yeah, the point I was trying to make is like, and you and I were talking about, it's not surprising to see that Blue Owl that really started off in 2021, 5 years later, is starting to see some heavy withdrawals during all this turmoil, and most likely when a lot of their loans are maturing. And then on top of that, you brought up the idea. Sorry, I lost my train of thought. Where was
About
I
interest rates.
Oh,
I'm
yeah.
assuming that's what you're going to
Yeah,
bring
no,
up.
interest rates going down, but it was something else. Must have not have been important, but I don't know. I'll let you take it back. But yeah, I find that all interesting, but not surprising. Oh, you were talking about why they can't give all the money back. So I'll let you take it.
Yeah, their money's tied up in not a big old bank account that has billions
sitting
of
there.
dollars in it, right?
I mean, name an entity that has all your money in a big old bank account.
I don't know.
Zero entity.
Yes, I don't know it. I do know Blue Owl. I was reading about 70% of it's within software and IT. That's where a majority of their investments come.
Yep.
But they do also have a space in commercial real estate as well, right? And when you're talking about these investments, again, these are not liquid investments. This is not cash. So when you have this, your, equity parked somewhere that's not liquid, and then you have a bunch of your investors come and ask for cash back, and you don't.
Yeah.
You got it. You're forced to make a decision.
Oh, yeah.
And that's a fire sale, most likely, depending on where you're at.
Yeah, I mean, we're not at a fire sale level
I
yet.
don't think
and
so
yeah,
yet. I
something
agree.
like
I agree.
Blackstone and BlackRock, they're not going to have any troubles. They got enough meat that this is something that they're probably, one, prepared for, but two, able to dig out of. But yeah, Blue Owl.
Yeah.
I do find it interesting also that you point out, yeah, they're in the commercial industry, and I do want to come back to that as being a major effect. But here's an interesting idea, and I haven't delivered this to you yet, but they're invested in technology too, right? Softwares particularly, correct?
Correct.
Yeah, so how might that affect the real estate market? I was reading an article about the heavy investment that major companies made into automation softwares like CRMs more particularly. I mean, everybody, you got these small business coming in, and one of their biggest objective is to build a customer clientele. So they need voice over IP networks, they need CRM managements, they need domain, website, and email holders. So all these different companies are competing and coming up with new softwares to automate this stuff for you, right? And then, that started 6 years ago, 7 years ago, and these investments went in there, right? All these dollar bills are now invested into these softwares. And now we have this huge overcome and development of AI, right? And AI agents more particularly that can take over the demands of having a human being need that software, right? So originally it was like Earl starts a business and he has 5 employees, and he needs those 5 employees to manage their customer relationships through the CRM, which is one of the big CRM competitors, right? You guys have probably seen so many commercials on, I don't know, I can't think about it. Monday.com, Salesforce, different big entities, right? A lot of companies are doing their own software development. That's where all this money was invested in. But now Earl has this new AI technology, and he can create what is called an agent to do all these medial tasks and save money on the software that makes it easier for his 5 employees to do all this through, and instead just invest it all into this AI agent that doesn't need software and can just get it all done automatically, right? So what am I trying to say? The real estate industry is heavily based off CRMs, VoIP systems, softwares. The real estate industry is tremendously reliant on digital technology. And so when you have all these major firms investing in softwares of that sort, and then you have AI come and take it over, what is that going to do to the industry, right? I don't have an answer for it, but it is just interesting to think If you want to be a successful real estate agent, slash firm, even a lending agent or firm, or a lending broker or banker, you need to have a well qualified CRM. You need to have a well qualified, contact basis, whether it's VoIP, email, or some kind of strategy. And pretty soon, you might not need all those things because you can have AI technology automate it for you. So that in general could also affect the real estate market. Am I making sense? Going on a
You
limb
are.
here.
You definitely
Yeah.
went on a tangent there.
Yeah, but it's just I thought it
There's
was
no
kind of
doubt.
cool.
That is an interesting
Yeah.
concept, and that's definitely right up your alley.
Yeah, right. Well, painfully up my alley.
Buildings, CRMs from the ground up.
But in regard to the more obvious side, the commercial real estate industry, what would you say, and how might you say that would affect, say, your common investor and or your common residential owner?
Well, there's a lot of things to look at there.
Yeah.
But, when you look at, again, pricing and availability, and we talk
Yeah.
about all these things, right? And specifically in residential, right? We have all of this money, whether they're these big investment corps are selling off their assets or whatever the case is, they're being pulled out of these businesses.
Yep.
Being pulled out of small businesses, and that affects from everything from the top down. I mean, their employment rates, they might have to lay some people off. They're going to halt their growth because they're not going to have as much capital and liquid to invest in their growth. This has a potential to affect people's jobs. This has a potential to affect cost of goods.
So less money flow, less
money
confident in
flow.
money affects the real estate. Definitely.
Absolutely.
Yeah. Residential. I was also thinking on a different route. You got these major firms, which are the primary targets for these private credit companies, right, to give loans to. And they're not really, going to take much of a look at a smaller LLC or a smaller investor. And I could almost argue most smaller investors might not even know how to get a private credit loan, right, through these entities. So it might not even cross their mind. Most small LLCs that are looking at a 3, 4, or maybe even a 2 or 1 unit investment property are going to go straight to the bank.
Mm-hmm.
And it sounds to me like more opportunity might come up in which these smaller investors can take advantage of this problem, right? Because these major investors that are getting credit from these private credit unit companies and buying out, say, 20 properties, 24 unit properties, 20 single family properties, they might not be able to drive that market or run that market as well because they might have more difficult or more obstacles to jump through in the future after all this calms down when it comes to getting a private.
I was going to say they're going to have a little
yeah.
bit more restraints than
They're going to have more restraints, and that might strengthen the opportunity for that
for
smaller,
cash-heavy small investors.
cash-heavy small investors, or even small investors that are trying to get a loan from a bank or something like
absolutely.
that. So, yeah, I can't see only bad coming from this, right? Because if you have more people trying to get a loan from a bank, you have more economic flow. How can that be bad for a real estate industry? Something to think about.
And not only that, but again, we're entering that weird silver tsunami era where there's a bunch of homes that are available and going to become available.
Oh, yeah.
And I was trying to look up and do the research to see what the percentage of homes that are inherited are sold, because I think it was something crazy, like 70% last time I looked.
Yeah.
That's a big number, right? And when you see this generation start to downsize and you can see all this inventory out, are we going to see some sort of price correction? I don't know.
Yep. No, I completely agree with you. So yeah, the industry is like so littered with wholesalers, fix and flippers, companies that are trying to buy up bulk properties, 15 properties at once with one loan, maybe through a private credit company or anything like that. And I could see that maybe because of this little bubble that's starting to fill, taking a break a little bit. And I think that only helps the cleanliness of an industry. So I'm not saying this will happen, and I'm not saying good will come from this, but I would argue it's something that you should definitely monitor if you're a smaller investor and you got some money and credit to play with, and you're starting to look at the industry and see if it's your time to strike. It might be, because people are starting to pull out of the residential, the commercial, and the investment real estate industry, because it's more difficult. They have less confidence in private credit, right?
And I think that's great. You said monitor it, because it's really nothing more you need to do right now than monitor it, right?
You'll know. If you pay attention to something long enough, you'll slowly conclude when to strike.
The market has not collapsed.
No.
We have not collapsed. We are not in a recession.
I can't see it collapsing either, just due to the fact, or at least from this, because it's so funny. The level of ignorance that we had in 2008 when it came to loans, the thing that would cause something like that isn't going to be able to be identified on a YouTube video or a podcast.
It's not going to happen.
If that makes sense, right?
If it was that easy, it wouldn't be that easy for it to happen.
Exactly. So, no, I don't see something like this causing too much havoc, but I think it could create opportunity if you're an investor and you're trying to get into the industry, trying to utilize your money a little bit more strategically. Definitely monitor it. Yeah.
And especially if not even just investors, right? If you're looking first-time home buyer, or you're looking to get into the residential market or make some changes, and you can, and you're capable of doing it now, you should really consider look into it and do it now.
Oh yeah.
Don't wait.
No, definitely. Yeah. I mean, what else? What other ideas did you have that you wanted to talk about? How much time do we got?
21.
Oh, we're at 21 minutes. Cool.
Time flies
comfortable
when you're
with
having fun.
Yeah. So we have 21 minutes in. Cool. I mean, I'm pretty set on that as a topic.
I liked it.
Cool. Anything else you want to add?
It's like going off of different tangents that aren't like
cool.
Yeah, it's more just like St. Louis.
What?
Like pending home sales rose in February, but it's again hard because that was when rates were low before. It was in a weird time when that happened.
I guess I would kind of close out with this idea. Don't jump to conclusions. Don't be scared to enter the market, right? If you want to speak to a professional, definitely reach out to us. It's very important that you analyze something like this for quite some time, and you don't just jump in based off what one YouTube video told you. The details that we're talking about might be really, really heavy in knowledge-wise. So I recommend maybe you go on, read an article, watch a couple other basic YouTube videos that really dig into what private credit is, where private credit started, and what their motivation is. I also recommend you guys look into the terms that we're talking about and the idea of a mature loan and why they might be pulling out. And then more importantly, recognize the opportunity behind something like this, right? Recognize that bigger firms suffer when forest fires happen. And I liked it. An economist put it, I forget his name, he put it a good way. He said, small plants can't get the sunlight because the big trees in the forest block them out. But when a forest fire comes through, it'll take out a lot of those large trees, creating sunlight for those smaller plants to grow. So it's very important that you recognize something like this as not a time that you should stay back and play it safe. But if you have the ability to take the risk and you have less to lose, this could be a perfect time for you to jump in, right? This could be a perfect time as long as you're willing to work hard and do your research to avoid larger mistakes. Get professionals such as us, professionals like lenders that we would advise, lawyers we would advise to assist you with this, and of course, other creditors that can give out loans. All in all, this is a good time, just like any other time, to be a private investor. Small investor jumping into the market, particularly around those 2, 3, and 4 investment properties. So that's my peace of mind.
And if you don't, you just might regret it in 5 years, which you probably will.
Yeah, right. Look back 5 years ago. What do you got? Either way, I think we're good. Once again, my name is Robert.
I'm Chad.
And we are Intellectually, the show that teaches you how to hold us more accountable, if that makes sense, right? All right. I'll see you guys later.
For now, it will.